holding in your bank. Okay. So investing is a process which helps you to grow your money, to grow your assets. Not necessarily money. Money is a form of asset, but there is a different type of investing. You can invest in stock market. You can invest in real estate. You can invest in gold. You can invest in certain other tradable assets which are available. I think someone's mic is on.
By strike.
Yeah. So I'll proceed. So I was saying, when you're investing, you're basically trading. So what is investing in terms of stock market? You're actually buying a certain amount of shares with you, and you're keeping those shares in a particular dematerialized form. Now, what those shares are saved in a hello. I think there is a lot of echo. Can everyone keep the mic on mute?
Everyone, please keep your mic and camera on mute or just close it. If you open your mic, chances are
Hello.
might echo. Okay.
क्या
Okay, thank you. Okay, so
I'm very
uh,
sorry, Pratik, for the disturbance.
no problem. That's fine. I understand. So, as I was saying, investing. Now, what is investing in terms of stock market? So, investing is something that you are buying a certain amount of shares with your money, and you are keeping those shares in your demat account. Demat account is nothing but an account which holds your shares safely. Now, demat account stands for dematerialized form of account, where just like you are storing your gold in your locker, similarly you are storing your shares in some sort of locker which is called as a demat account. I'm just explaining in a very plain simple language. And these demat accounts are actually held by two biggest depositories. One is CDSL, which is also called as Central Depository, and then there is NSDL. Okay, so CDSL and NSDL, these holds your securities or your shares in a dematerialized form, so that tomorrow going forward, if you want to sell those shares, you can easily pick up those shares and sell it to the another buyer who wants to buy those shares on the desired price. Okay, so while investing, what is happening? You're buying those shares from a stock market at a certain price. At a let's say you want to buy a shares of Reliance, and Reliance shares are trading at, let's say, 2,200. Okay, and any one of you feel that this is a good price. I can buy those number of shares. I can keep those shares with me. I can invest my money, and when the price goes up after a certain amount of time, I will sell those shares. So when you're buying those shares, you're buying through a medium, that is a platform, the broker which I earlier described about. From those broker, you're buying those shares, and then those shares, once you buy it comes into your demat account. So demat account is storing those shares, and once those shares are stored, it will be reflecting in your portfolio, in your trading portfolio or your account portfolio, that you are holding this amount of shares, and those amount of shares going forward, when the price goes up and down, it can be traded further. Okay. Hello. Yeah. So investing, like I said, investing is also some form of trading, but trading is not form of investing, because when you're investing, you're actually trading. What is a trade? A trade is something that when you're giving in something in return and taking in something in return. So here what you're giving an amount to a seller, and you're taking shares from that seller and storing that shares in your account. So a trade is happening between two people. One is let's say a buyer A, and there is a seller B. So buyer A wants to buy X number of shares, and the seller wants to sell X number of shares. So those buyer and seller, when they meet each other, when there is a desired price, expectations meet up, so those buyer and seller are doing a trade, and that is why it is called as trading. Hence, investing, while doing an investing, a trading is happening. But when you're doing a trading is something that it is not necessarily investing is, I would like to say there are certain forms of investing. There are short term investors, there are long term investors, there are different positional investors. Short term investors are the people who hold shares for minimum 6 months to 1 year of time, or sometimes they also hold it for 3 months of duration. However, there are some mid to long term investors who hold the company shares for around 2 to 5 years, and then there are a long term investor who hold shares for more than 10 plus years, 10 or 10 plus years. So there are different form of investing, so depends on what type of investor you are, how long you want to keep your money invested in that particular equity. So that is what defines an investor. Okay, so like I said, investing is a part of trading, but trading is not an investing, because trading would be like you are buying a share today and selling it today itself. That is an intraday trading, which we call. Okay, you might have heard in the market, but that is not a form of investing actually. Investing would at least involve holding shares for a small amount of time in your dematerialized account and then selling it. Okay, going forward, next slide. Now, trading, like I said, so trading concept will be more explained by Mr. Vishal, but let me give you a heads up. So there are different types of trading involved in the market. Like I said initially, trading are for example, intraday trading is there. Then there is a swing trading. Swing trading is something where you're holding a particular equity for minimum uh, 2 3 days to 1 week or maybe 2 weeks, and then selling that equity back and gaining profit. Or sometimes when you feel that you have received a good amount of profit, you can sell it next day also. So there are different forms of trading, there are different forms of investing. So it depends on the characteristics of a person, how good you are at, what is your patience level, what is your knowledge and expertise, and that will actually define whether you are a good investor, whether you are a good trader, or whether you are both. Okay, so that's all from my side. I'll be also getting involved in between. So let me pass on to my.
All right. Thank you, Pratik, for this knowledge. Right. So hope you guys now have a decent understanding about what is the stock market, how it works, right? What is a share, what is a stock, and a broad classification between the investors and the traders, right? So let me make it clear again. Investing is basically a process, right? It basically requires you to put in your money into a company, right, in a business, and participate in its growth process. All right. So in the investing is a passive way of building your wealth, isn't it? So if you have, say for example, 2000 rupees, right, and you find that so and so business is doing well in the stock market, so what you basically do is, yeah, you invest your money into that, you buy its shares, and you hold it for however long you want to. All right. So making it clear, investing is not going to make you income, right? It is not an income source, right? It is a passive way of growing your money, growing your wealth over time. All right. So investing, again, it requires you to find out good businesses in the stock market, those which are undervalued. All right. I'll come to that in a moment. So once you are done with that process of finding out a list of businesses, what you do is you invest your money into them, right, and you let it grow basically. All right. So now coming to trading, right? So what is trading? Who are the traders in the stock market? So here I would like to address the term, right, speculation. All right. So say for example, you you are using basically some kind of techniques in the market that is basically telling you that where the prices are going, right? So say for example, you are trying to predict the price movements in the market. As you already know, stock market is a big place, isn't it? There are a lot of buyers and sellers involved in this. At each point of time, when the markets are open for trading, there is a lot of fluctuation going on. So when it comes down to traders, what they do is they take the help of some skills, right, which they learn. I'll come to that in a moment, right? So using such skills, right, what they do is they predict the price movements in the assets, right? More thing that I would like to address here, as shown in the slide, is investors, again, they are not interested in short-term capital gains, right? So say for example, you put in 2,000 rupees into the market, right? And in the next 2 to 3 months, what you can see is you have 1,000 rupees as your profit. But if you are a genuine investor, you should not get excited by looking at the short term profits, right? What your view is that you have to remain in the stock market, you have to remain invested for a long period of time, after which you can multiply your wealth, right? So that is the basic ideology behind investing. And when it comes to trading, it is all about short term capital gains, right? So if you put in your money in some asset, right, or in some commodity, right, and you hold it for some time, or maybe this is just an example, first of all, right? So if you have some kind of a profit being generated on your profit, on your capital, then you take it out, right, and you enjoy it. So that is the process of trading. And how to get started in this, I am going to address right now. All right, so roadmap to be a trader, right? So this is the main part of our today's webinar. Again, being a trader, being an investor, I hope everything is clear. uh, right, you must be having everything clear in your mind. So now let's come down to the roadmap to be a trader in 2022 2023. All right, so the first thing, right? Who is a trader? Again, this is very much clear. Now you can see here on a slide that these are the set of steps. These are the things you should make sure to have an idea on in order to get started as a trader. So the first thing that I'd like to consider here is understanding the financial markets. All right. So again, whenever, whether it is investing, whether it is trading, if you want to get started in anything, right, you have to understand the stock markets, right? And by now I guess you all will have a decent idea about the same, right? So understanding the financial markets, understanding how things work, right, that is very important for us to understand, right? So once you have a basic idea about the stock market, you move into the most crucial part of being a trader, that is learning technical analysis. All right. So technical analysis, it is just, I'll try to explain it with one example. So I'm sure you must have, come across this kind of charts, right? So say for example, of course this is a very new platform for everyone, I'm very much sure of that. So giving an idea about the same, this is a website that is called as your trading view, right? So trading view is a website where you can actually find the price movements of all the assets across all the global markets, right? So whether it is cryptocurrency, whether it is the Indian market, whether it is the US market, you have everything, all the data here, right? So technical analysis is what, first of all, so you can see that here on my screen what I have is price fluctuations, isn't it? So by now I think you must be clear that here on the right side of our screen what you have is a scale, right? This shows the price of Reliance, so I have the price movements of Reliance being shown on my screen. All right, and here you can see this is the time duration, this is July, August, September, October, right? Hope this is given, hope this makes sense. All right, so as you can see, what we can understand here is the price movements of Reliance over time, right? So what technical analysis you can find out some kind of price movements at every point of time, right? So by looking into this, by analyzing this, right, of course I'll come to that, you can actually predict the price movements that Reliance might have in its future. All right, hope this makes sense. So again, technical analysis, this assumes that with the help of the past price movements, you are trying to find out the future price movements in various assets, right? Hope this is clear. Now again, coming to this, you can see that these are some green and red bars being shown here, right? I'll just change my chart in a moment. Okay, so you can see here, right? So again, if I just zoom into this, right, you can see that there are these are called as your candlesticks. All right, so what are candlesticks? Of course, I'll not come into the depths of technical analysis in this webinar, but I'll just try to address a few brief concepts on the same, right? So you can see here that the prime, key that is representing the price fluctuation in the market, that is your candlesticks, right? So these small bars, right, you have this small lines on the upside and the downside, right? So these are basically what these are trying to give you an idea of how the price of an asset has moved within a period of time. All right, say for example, what I have is this one, this big red green candle you can see here. This is what I have encircled right now. So before coming to this, I have a setting enabled on my website which shows that each candlestick here, each candlestick is going to represent the price movement uh, of any asset within one trading session or one day, right? So say for example, if you don't have an idea about this, the Indian stock market opens at 9:15 a.m. and closes at 3:30 p.m., right? So everything between that, from 9:15 to 3:30, that is going to be shown by this one candlestick. All right, so again, what is this? You can see here that the colors are defined here, right? So one color that you have is your red, and the other you have is your green, right? So what this tells you, I think it is very much self-explanatory, that when we are talking about a red candle, it is basically telling you that the price of the asset we are looking into, in this case we are looking at Reliance, right? So Reliance is the asset we are talking about. So by a red candle, right, you can see here I have marked this red candles. What is this trying to tell you is your price of Reliance has gone down on that very day, right? So here, if I just hover above this, on the bottom you can actually see which date it is, right? So it is the candle of 19th August 2022. So on that day, the price of Reliance has gone down, right? So obviously red indicates that the prices have gone down. If I were to talk about a green candle, this means that the prices have gone higher. All right. So again, if I hover around this candle, what you can see here is that the prices have moved higher. All right, on 23rd of August. So in this way, right, we actually try to predict the price movements by drawing some patterns here, right? So by analyzing this price fluctuations based on this candlesticks, based on what the chart is headed towards, what is the direction of the price being shown. As you can see, initially the price was going up, then it is more or less sideways, then it is going down, right? So of course you can establish some relations between everything, right? So technical analysis is all about that, right? You try to understand this price fluctuations in a better way, right? And you learn these concepts, right? And the main, again, the main thing of the main motive of technical analysis is to find out the demand and supply in the market, right? So again, let me just elaborate on the same, right? So this is one more major concept that I will be talking about. So that is your supply and demand. So everything in your stock market, right, that works on the principles of supply and demand. So what is it? I think it is very much self-explanatory that whenever something is in demand, right, something is in high demand. Say for example, I'll take the I'll assume a seasonal fruit, right? So let's take the example of mangoes, right? So everybody here must have an idea about how the price of mangoes go on in the seasons, right? So what happens is initially the prices are very high. Why is it so? Because the supply is very low, isn't it? There are hardly a few shopkeepers selling mangoes initially, right? So what happens is that they charge a huge amount of money, and there are actually people willing to buy that, isn't it? Especially in the initial phase of the mango season, right? So what happens is with time, right, the prices go down. Why the prices go down is because the supply increases. There are a lot of shopkeepers, there is a lot of supply, right, coming into the market. So what happens is when the supply is higher, the prices come down, right? So obviously people pay lower amounts of money to buy mangoes, right? Again, by the end of the season, what happens is the prices go higher. Why is it so? Because again, what you have is your uh, supply getting lower, right? So that is the whole price action of mangoes, isn't it? Throughout its seasons, initially the prices are higher, then the prices go down, and then again the prices rise up. The stock market exactly works in the same way. All right, so what happens here is whenever there is higher supply, right, I'm talking about supply, right? So higher supply means here that there are a lot of people willing to sell the shares of a company, right? So whenever there is a higher supply, the prices of that share will obviously come down. And again, when a lot of people are willing to buy the shares of that company, the prices will go higher. All right, so that's how the markets work, isn't it? Whether it is your real day-to-day market or whether it is your stock market, everything works in the same way, right? There is the principle of supply and demand coming into play, right? So by the help of your technical analysis, you basically find out where there will be a better demand, where there will be better supply, right? And based on that, you buy and sell the assets. All right, say for example, you find out that Reliance at some point is going to have a better demand, right? So what you do is you buy it beforehand, right? So once you buy it, then lots of buyers come in, they push the prices up, right? As I have given the example of the mango, it works the same way, right? So what you do is when you buy, right, the buyers come in and eventually the prices go higher and you make a profit, right? So this is how the stock market works. This is how technical analysis works, right? So technical analysis is basically going to help you understand the price movements, and the major part of you being a trader, the major learning phase is with your technical analysis, right? So everything you need to focus on here is first your technical analysis. All right, so again, coming back to the roadmap of being a trader, right? So the first thing, again, understanding financial markets. The second thing, that is your technical analysis, right? Now the next thing that is very very important, right, that is your risk management. All right, so I hope the first two points are very much clear to you by now. This third thing that we are going to focus on is, of course, your risk management. So what is risk management? So one has to understand one thing, right? So whenever you are trading in the stock market, right, you can't be 100% right in your speculation. All right, if you predict that the prices will go up or the prices will go down, you can't be 100% right in it, right? This is the major disadvantage of technical analysis. All right, so technical analysis, with the help of its concepts, you will never be able to pull out 100 in. All right, so that is why you have to understand risk management. Why is it so? Because if you were 100% right, then why the term risk would come in, isn't it? Right, your money would be safe, right? You would buy something, it will obviously go higher, then the chances of you losing money is zero, isn't it? But that does not happen here, right? uh, the best accuracies of the best no, the accuracies of the best traders in the market have hardly been 60 to 70%. All right, so that is one thing to be addressed here. So now coming to the risk management, right? So what is it basically? So it is a way of handling your capital, right? It is a way, it is a set of rules, right, that you implement in your system. right? That is basically going to ensure that your losses in the market will be limited, right? And your profits are going to be higher than your losses, right? So that is how you remain profitable, isn't it? Say for example, you take 10 trades in a month, right? This is just an example. Say for example, you buy and sell 10 stocks in a month. So obviously this is based on your speculation, this is based on your prediction. So say for example, 5 out of 10 times, right, you are right in predicting the price movement and you have made a profit in that. But the rest of the 5, right, you were wrong in that, right? So overall what you can see here is that 50% of the times you have been right, correct, isn't it? Now risk management is basically going to ensure that even if you are only 50% of the times right in your analysis, you are still going to remain profitable at the end of the month, right? At the end of the month. Hope this makes sense. You took 10 trades, you failed, 5 of your trades failed, 5 worked well. Risk management makes sure that the profits generated in your 5 trades, that is going to be higher than what losses you have made in your rest 5 trades. All right, hope this makes sense here. So technical analysis, that is going to that is basically the skill that you have to develop in order for you to analyze the market, and risk management ensures that you don't lose a lot, isn't it? So keeping the losses limited, keeping the profits higher than the losses, that's how trading works, right? So trading is a game of consistency. It is a process, right, where you balance out this risk, balance out this reward in order for you to remain profitable, in order for you to generate a decent the end end of your month, right? So it is a job, it takes a lot of time from your side, right? So that is how trading works, right? Even hope this made some sense, right? It is a set of rules, I'll come to this in a moment, right? That is basically going to suit your mindset, right? That will go hand in hand with how you analyze the markets, how you look into the market, right? How much losses are you willing to take, right? Are you comfortable with, right? What is your risk appetite, right? That is going to take care of everything, right? And you will also have your risk management rules in place. And once you are geared up, once you are armed with all these concepts, all this goodies, you are going to step into the market, real market, right? So obviously creating a profitable trading system is all about your technical analysis and risk management balancing out, right? And keeping everything in mind, we enter our fifth stage, that is your back testing, right? So what is back testing? Again, you have created a system, isn't it, in the market? You don't know how well is this going to work, right? You have a set of conditions defined, right? So yeah, I'm going to sell something at this point, I'm going to buy something at this point, but you don't really know how this will work in the real market, right? So back testing is something, it is very important. So once you are done with the first 4 set of steps, what you do is bring some amount of money with you into the market and you test your skills, you test your system, right? So back testing actually takes a decent amount of time, right? At least 2 to 3 months on any for any trader, right? So once you find out that yeah, your system is working well in the market, so you then bring in a decent amount of capital and get started as a professional trader, right? So hope this makes sense, guys. This is the roadmap to be a trader. I'll just go through all the steps again. So again, what you have is understanding the financial markets, understanding technical analysis, learning it, then coming on to the risk management. This is basically a set of rules, right, that you would like to implement in your trading style. Then what you have is creating a profitable trading system. Then you back test your system. Then you get started as a professional trader. All right, hope this makes a decent amount of sense. Obviously these are very new concepts, and grasping them at these phase, at this initial stages of learning, it's a bit difficult. But obviously there are a lot of geeks amongst you who have that finance kira in their head, so obviously they should have a decent idea about all of this. All right, so again, coming to all the concepts, I would really like Pratik to add on to this if he has to. All right, so down to you, Pratik.
Yeah, thanks, Vishal. It was very helpful information. So basically, like I would like to focus more on the risk management because that is one of the crucial, I would say, important uh, factor in the stock market. Risk management is not only important in stock market, but it is also applicable in day-to-day lives. See, every now and then, every day-to-day, if you see, we are taking some sort of risk. Okay, unknowingly, there are I know I'm saying a little bit of negative side as well. You might have heard from people, are they those people lost some amount, so and so amount of money in the market. See, that is because they are not properly doing a risk calculation. Okay, so there are always risk, whether you are doing trading, whether you are doing investing, whether you are doing any sort of activities in your day-to-day life. For example, you have taken an are investing an amount for your future career growth. So you have invested an a money. So if you don't learn, if you don't study, your getting a job, these all kind of things involves risk. Similarly, in stock market, they are able to properly survive in the markets. They are able to grow their capital in the market. That is the main reason behind it. So when you're taking a risk, see, investing money or trading with the capital, it always involves a risk, whether you're doing it in let's say stock market, whether in any form of asset, even in real estate. Let's say tomorrow you're buying a house. What happens if the house means it is not on a stable place, or if there is a earthquake prone area, anything means like, even if you are buying gold, although gold they say it is a very valuable asset, but sometimes when even the gold prices depreciate for a certain amount of time, although in long term future, no doubt gold is a good investment, but the capital, the rate at which it will grow, it will not beat the inflation. See, like the word inflation is very much important here. I would like you all guys to take a note on this thing, because every now and then the capital of each and every person keeps depreciating, because when the inflation keeps on increasing, the value of 100 rupees tomorrow will be 90 rupees, not tomorrow exactly, going forward in the future, but it keeps on shifting its stance from that. So taking a risk is always good, but taking a calculative risk is a real, I would say, real mindset of a person who can properly trade in the market. Okay, so whether you are trading or investing, always calculate the risk of the amount that you're going to take. Tomorrow, if anything happens in the opposite side, so your capital gets protected. For example, tomorrow, let's say, now you might have heard about a very famous company. I would not like to name it, but there is a famous company, Paytm. We all use it now. Day to day is going to the shopkeeper, paying our means money through Paytm or any other form, Google Pay or anything. But since Paytm is a listed company, the moment it got listed in the market, it started falling. So people who would have done a calculative risk, those people would have got out from that trade, and people who kept on hoping that the Paytm price will keep on increasing, now their capital is reduced to 50%. So somebody who would have invested 1 lakh rupees, now their amount in the account would have left for 50,000 only. So make see there are people who make losses in the market too. This is a bitter truth. The more or the more quickly you because nobody in the stock market is 100% right. Not even a single. Even Warren Buffett, who is a renowned investor, he also makes mistakes. He also makes lot of bad decisions. But when they make bad decisions, they definitely have a proper risk calculation. They get out of from that stock. Okay, so best of the best people, they do risk calculation, and that is what you should be doing it. Okay, so like in the risk management, it is explained taking limited risk. Limited risk is like tomorrow, there are many even renowned companies who would have been listed in stock markets. Now you might have heard about this familiar term Nifty or Sensex. See, Nifty and Sensex is nothing but indices. Just like in your textbook you have index of your chapters. For a number of, let's say there is any sort of English textbook, and there are different chapters available. What are those chapters consist of? So there is an index. That particular index represents the summary of those chapters and summary of those topics on which page it is listed. Similarly, there are a group of stocks which are good in terms of weightage, which are good in terms of brand value. Those are selected by official regulatory authority, that is called as SEBI, Security Board of Exchange. Okay, SEBI is a body which manages the transactions which happen in stock exchanges. So they are there to overlook. They are like what do you say? Keeping an eye on irregularities that happen in the stock market, so that they can curb that irregularities, and the investors amount stays protected. That is their duty. So they will actually look into those matters. So when you are taking this amount into stock market, that obviously involves a risk. So the company tomorrow, if they declare bankruptcy, or the company promoter has taken a huge amount of loan, and now they are in a big debt trap. So uh, s- uh, so that the invested or the trading capital which you have bought a stock